AS Level Accounting, February-March 2022, Paper 12. Question number 11. A capital account for a sole trader contained 3 entries in addition to the opening and closing balances. What did these entries represent? They are given capital account debit side and credit side. Here the answers are given. Capital introduced. Capital introduced always on the credit side, not debit side. Drawing on the debit side. So first option is wrong. Second, capital introduced on drawing. Capital introduced on not the debit side, drawing debit side. Profit for the year, credit side. But the complete option is not correct. C, drawing and loss for the year, yes, debit. Capital introduced, credit. Then D, profit for the year. Capital introduced, credit, drawing, no. So the correct option is option C is the correct answer. Next, question number 12. The year end of a business is 31st December 2021. So the beginning will be January 1st. On 5th January 2022, inventory was counted and valued at cost 30,000. The following was then discovered. Goods purchased and received after the year end costing 1,500 had been included in the valuation. When we are valuing the inventory, we enter in the income statement only the current year inventory value. So what is the question they are asking? The question is, which value of inventory should be included in the financial statements on 31st December 2022. But this goods purchased and received after the year. They received and purchased after the year. So this 1,500 we should deduct. Then it included goods returned by a customer after the year end. Again, good returned by the customer we should deduct. They had a selling price 900 which included markup 25%. So inventory always value at lower of cost or net realizable value. So here we have to calculate the cost because the selling price is given 900. So what is the cost? Here markup. Markup means profit calculate on cost. Cost is not given. Here they are given the selling price. So we calculate on margin. So the difference between selling price and margin is equal to cost. So markup is given 25%. 25 divided by 100 is equal to 1 by 4. If markup is 1 by 4, margin is how much? Margin is 1 by 5. So the margin amount is 900 multiply 1 by 5 is equal to 900 into 1 by 5 is equal to 180. So the cost is now 900 minus 180. Cost is equal to 900 minus 180 is equal to 720. So the 720 also we have to deduct minus 720. Then third one we are done, two done. Third, some goods included. Some goods included the inventory costing 500 were damaged. They can be sold for 300 after repair costing 100. After repairing the costing, the cost of the inventory is 300. But before it was 500. So the lower price always we take 300. This 300 also included. So we have to, some goods included the inventory 500. They can be sold for 300. That also we have to deduct. So what is the correct answer? The cost of the goods was 30,000. This is 30,000 minus 1,500 minus 720. 30,000 minus 1,500 minus 720 minus 300. The correct answer is 27,480. Option A is the correct answer. Question number 13. A sole trader provided following information for the year ended 31st December. Non-current asset, current asset, non-current liability, additional capital, drawing. What is the question? Question is, what was the profit for the year? Profit for the year is equal to capital minus additional capital plus drawing. Profit is equal to net capital, closing minus opening capital, closing minus opening capital minus additional capital plus drawing. Here closing and opening capital is not given, but the net amount like increase or decrease, the difference between closing and capital is given. So we have to take one capital like non-current asset plus current asset minus current liability is equal to net capital. Non-current asset increased, so plus current asset minus current liability plus minus. Then additional capital minus additional capital plus drawing. Minus additional capital, while drawing we will add. So plus drawing. So what is the total? 15,500. Correct answer is C. Next. Question number 14. Which rule does not apply in the absence of partnership agreement? Interest on partners' loan is charged at 6% per annum. So the correct answer is which is does not apply. So interest on partner's loan is not charged 6% per annum. So this is not apply. So the correct answer is A. Next, question number 15. P and Q are in partnership, sharing profits and losses equally. On 1st January 2021, the partnership had net asset 410,000. At that date, R was admitted into the business on the following terms. What are the terms? Net asset revalued. Net asset is revalued at 480,000. Goodwill valued 50,000 but not retained in the books. Profit and losses will now shared P, Q, R percentage given. What was the change in Q's capital immediately after R's admission? So we can draw one capital of Q. Q's capital. First, revaluation reserve. The net asset before the price of net asset was 410,000. Now it became 480,000. It increased. How much increased? 480,000 minus 410,000 is equal to 70,000 increased. So this revaluation reserve, before they were sharing the profit and losses equally, so divided by 2, he will get 35,000 revaluation reserve. It will increase the capital. Increasing capital on the credit side, decreasing capital on the debit side. So revaluation reserve 35,000. Next, goodwill was valued 50,000 but not retained in the books. So when one partner is admitting the existing partners, if they are sacrificing any portion of the goodwill, they have to get that goodwill from the new partner. So before, how much the goodwill in the old ratio and new ratio? We'll check the goodwill in old and new ratio. So goodwill before it was 50,000. 50,000. So before P got, old partners are P and Q. P and Q got how much? P share 50,000 divided by 2, 25,000. Q 50,000 divided by 2, 25,000. But now what is, we are checking only with the Q. What is Q's goodwill with the new ratio? Q's goodwill new is equal to 50,000 multiply. What is the new ratio of the Q? Q's new ratio 40%. 40% is equal to, he is getting 20,000. But before he got the goodwill 25,000. Now he get 20,000. So 25,000 minus 20,000, 5,000 he is sacrificing. So this 5,000 he should get from the new partner R. So that he has to get from the new partner. So it will be credited to his capital account. So on the credit side we write he has to get from R's capital. So you write here goodwill, how much? 5,000. He's sacrificing, so he has to get his compensation. Next, now we are done. Revaluation reserve done, goodwill done. Next, that's it. So what is the total amount? His capital account will increase because credit side means increase. What is the total? 40,000. Correct answer is increase by 40,000. Option D is the correct answer. 16. X and Y are in partnership, sharing residual profit and losses equally. Partners are charged 2% interest on their drawing. Y is getting salary 10,000. Partners drawing is given. The profit of the year was 52,000. How much did each partner receive as a share of residual profit? So we have to draw one profit and loss appropriation account. Profit and loss appropriation account means that is in the view of partnership firm. Profit and loss appropriation account. So what is increasing the profit of the company? You enter on the credit side, decreasing on the debit side in the view of firm. So first we start the profit and loss appropriation with the profit 52,000 net profit. Then salary means firm has to give to Y. It will decrease the profit. So salary 10,000. Next, partners drawing. Here they are charging interest on drawing 2%. So here 12,000 into 2%, 8,000 into 2%. First one is 240. Second one 160. Total interest on drawing is 400. So interest on drawing means partnership firm will charge interest on drawing on partner's drawing. So they will get the money from the partner. Interest on drawing 400. So salary done. We are done salary. We are done the interest on drawing. Then profit given. How much the residual profit? What is the residual profit now? 52,400 minus 10,000. 42,400. 42,400. So X will get, they are sharing equally. So X and Y. 42,400 divided by 2, 21,200 they will get each. So the correct answer is option D. 70. Which statement are correct? Dividend can be paid out of general reserve. Yes, business can pay the dividend out of general reserve. Next, right issue can be made from the share premium account. No, right issue will not made from share premium account. Bonus issue will made from share premium account. Then third, general reserve can be created from retained earning. Yes, general reserve can be created from retained earning. So 1 and 3 is correct. Option B is the correct answer. Question number 18. A limited company had the following balances. 1st January 2021. Revaluation reserve, retained earning. Then profit for the year, they are given 105,000. Revaluation reserve 20,000 was created 2 years ago from revaluation of a property. Same property revalued again on 31st December 2021. Now this is revaluation loss 35,000. So we have to get the net effect. Then on 1st August, interim dividend $40,000 paid. Next, on 31st 2021, December, final dividend 50,000, but that is proposed. What is the question? The question is, what was the value of retained earning? Retained earning means undistributed profit plus reserves. So we can check first opening retained earning. Opening retained earning is equal to 142,000. Then plus profit. Profit is 105,000. Then revaluation reserve. Yes, here you have to check this. Before the revaluation reserve 20,000 they are given. Now before it was revaluation reserve 20,000, but here revaluation loss 35,000. Before 20,000, now loss minus 35,000. The net effect is minus 15,000. So revaluation loss is equal to 15,000 minus. You can put in the bracket or you can put minus. Then revaluation reserve we are done. Next, here dividend paid. Dividend, interim dividend 40,000 paid. Paid means it will decrease the retained earning. So interim dividend. Interim dividend paid 40,000. Paid means it is decreasing the retained earning. That also we put in the bracket. Next, 50,000 final dividend proposed. Proposed means the business company, they did not made the payment, they just proposed. So this we no need to take the proposed one. So what is the correct answer? You have to just do the calculation. 142,000 plus 105,000 minus 15,000 minus 40,000 is equal to 100. 92,000. Correct answer is D. Next, question number 19. The bank balance of a limited company was 390,000 before following transaction took place. So, the balance is 390. What is the question? What was the bank balance after this transaction? So, the bank balance is now 390,000 balance. Balance 390,000. Then issue of 500,000 shares, price is 0.50, premium 0.25 per share. So total is 500,000 multiply 0.75. How we get 0.75? 0.75 means 0.50 plus 0.25. So what is the amount? 500,000 into 0.75 is equal to 375,000. 375,000. So their issuing share means it will increase the bank balance. 375,000. Next, debenture was repaid. Debenture 100,000 repaid means we are giving the money. So debenture 100,000 decrease the bank balance we repaid. Next, bonus issue 100,000 shares 0.50. Bonus issue means company is issuing fully paid up shares to the shareholders. So there is no increase or decrease in the bank balance. There is no effect. So the total is here 390,000 plus 375,000 minus 100,000, 665,000. Correct answer is option B. Question number 20. What might cause decrease in company's non-current asset turnover? Options are increase in expense, increase in sales revenue. No, it will not decrease the company's purchase of new non-current asset. When the business purchasing new non-current asset, it will be the it will cost to decrease the company's non-current asset turnover. So option C is the correct answer.